So, you want to buy a farm, not a hobby farm with a few chickens. A real one, the kind with 500 acres of black Midwestern soil stretching to the horizon. You picture the sunrise over your own cornfields, the tangible wealth of land that cannot be deleted or diluted. A legacy asset that produces essential goods and runs itself with a hired manager while you collect the profits. It is the ultimate outsider fantasy. A safe, historically appreciating investment that lets you escape the volatility of screens and spreadsheets and own something real. It is not. What you are actually considering is the purchase of a highly regulated, capital-intensive manufacturing operation that is fully exposed to global commodity cycles. The land you covet is often a separate and more valuable asset than the operating business placed upon it. The real risk is not a bad harvest. The real risk is that you become a price taker, squeezed between a handful of consolidated input suppliers on one side and a handful of consolidated commodity buyers on the other. One weather event or one cycle turn away from catastrophic loss, with zero experience to navigate either. The first number you need to know is this. The average price of cropland in the United States is now over $4,000 per acre. In prime states like Iowa, that number jumps to over $9,500 per acre. A viable 500-acre row crop farm in the Midwest will cost you between $2 million and $4.75 million for the land alone. That is before you buy a single tractor, a single seed, or a single gallon of fuel. Money is only the first problem. So you have the cash. That is the first gate. Now you must find a seller willing to sell to an outsider. Farmland rarely hits the open market. In many rural counties, the best ground trades hands through private networks, word of mouth, and whispered deals after church. When a farmer dies or retires, the neighboring operation usually gets first right of refusal. The family handles it quietly. No listing, no sign in the yard, no opportunity for you. And when these generational transfers happen, the heirs often receive the land at what is called a stepped-up basis. That means the tax basis resets to the current market value at the time of inheritance. The family that has held the land for 60 years pays zero capital gains tax on decades of appreciation. You, the outsider buying at market price, get no such advantage. You are paying full price with after-tax dollars for an asset the neighbors received tax-free. This is the first structural disadvantage. It will not be the last. A public auction is where outsiders go to get outbid by a neighboring megafarm that has been waiting a decade for that specific parcel to become available. These operators know the soil. They know the drainage. They know exactly what that field has yielded for the last 30 years. You are bidding blind against someone who can recite the field history from memory. Your money is not special here. It is just money. If you do find a farm listed at $3.5 million for 500 acres, the commercial lender will demand a 25% down payment. That is $875,000 in cash just for the dirt. Then you need equipment, not one machine, an entire fleet. A late-model four-wheel drive tractor runs $300,000 or more. A 12-row planter is another $200,000. A combine with a corn head and a grain head can cost over $500,000. A self-propelled sprayer is $200,000. Tillage tools, grain carts, wagons, and an auger fill in the rest. A full line of equipment will cost you $1.2 million. Financed at 20% down, that is another $240,000 in cash before you turn a wheel. But you are not done buying. You also need somewhere to put the grain after you harvest it. A set of on-farm grain bins with drying equipment runs between $50 and $150 per bushel of capacity. For 500 acres producing 100,000 bushels, adequate storage can cost anywhere from $200,000 to $500,000 more. Without on-farm storage, you are forced to sell at harvest, when every other farmer in the county is also hauling to the elevator. Harvest time prices are almost always the lowest prices of the year. The farmer with bins can wait for a better market. You cannot. You have now wired over $1.1 million, and you have not planted a single seed. If you added grain storage, that number climbs closer to $1.5 million. And there is another capital cost hiding underground. The productivity of Midwestern farmland often depends on tile drainage, a network of perforated pipes buried 3 to 4 feet below the surface that removes excess water from the root zone. If your 500 acres has old or failing tile lines, replacing them costs between $800 and $1,500 per acre. That is another $400,000 to $750,000 to bring the drainage up to modern standards. Without proper drainage, your fields stay wet longer in the spring. You plant late. Late planting means lower yields. Lower yields mean less revenue on the same cost base. The drainage system is invisible from the surface, but it determines whether your farm produces 200 bushels per acre or 160. The previous owner may not have disclosed the condition of the tile. You may not discover the problem until your first wet spring, when the field that should have been ready to plant in April is still standing water in May. But the farm needs to operate before it generates revenue. You will need an operating loan to buy seed, fertilizer, and chemicals. For 500 acres of corn, that line of credit is roughly $225,000. The bank will secure it against your land and your equipment. You are now leveraged on the asset, leveraged on the machines, and leveraged on the inputs. The cash is gone, and the work has not started. Having the money still does not mean you are allowed in. The real gatekeeper is the existing farming community and the lenders who serve it. The United States Department of Agriculture Farm Service Agency offers direct farm ownership loans capped at $600,000. Guaranteed loans cap near $2 million. These programs are designed to help beginning farmers, but they come with strict eligibility requirements. You must demonstrate you cannot get credit elsewhere. You must prove farming experience. With zero experience, you are not a beginning farmer. You are a credit risk with a dream. The local Farm Credit Association, a cooperative lender that dominates agricultural finance, will look at your balance sheet and your resume. They will see a wealthy outsider with no production history, no yield data, and no relationship with the input suppliers who control your access to seed and chemicals. They will price that risk into your interest rate, or they will simply decline the loan. And even if they say yes, you still face a problem no amount of money can fix. The neighbor who has been farming for 40 years buys seed at a negotiated volume discount. He has a handshake deal with the local co-op for priority delivery of fertilizer in the spring. His crop insurance agent knows his yield history by heart. You have none of this. You are starting from scratch in a community that has operated as a closed network for generations. You will pay full retail for every input, while the farmer across the road pays wholesale. That cost difference alone can be the margin between a small profit and a large loss. The land is the cheap part. The permission to farm it is what you cannot buy. You have cleared the first two gates. You have wired over $1.1 million in cash. You own the land, secured inside a landholding limited liability company. You own the equipment, sitting inside a separate operating company. On paper, you control a 500-acre manufacturing plant for corn. This is where the business stops looking like the sign at the end of the driveway. Ownership is not the same as control. You control the daily decisions. You decide when to plant, when to spray, and when to harvest. But you do not control the price of a single input required to make those decisions happen. 3 companies, Nutrien, Mosaic, and CF Industries, dominate the North American fertilizer market. 4 companies, Bayer, Corteva, Syngenta, and BASF, control over 60% of the global seed and pesticide market. You are not negotiating with them. You are accepting their price. And the seed comes with strings. When you buy genetically modified corn seed, you sign a technology use agreement. You agree not to save seed from the harvest for replanting. You agree to follow specific planting protocols. You agree to allow the company to inspect your fields. You are buying a product you are not allowed to own after one use. Of course, they are very polite about it. Even the equipment you bought is not fully yours to control. Modern tractors and combines run on proprietary software. When something breaks, the diagnostic system is locked behind the manufacturer's dealer network. You cannot simply hire a local mechanic. In many cases, the machine must be transported to an authorized dealer, or you must pay for a dealer technician to drive to your farm and plug in a proprietary laptop before the repair can proceed. You paid $500,000 for a combine. You are not allowed to fix it yourself. The same dynamic exists on the other side of your operation. You do not set the price for your corn. The Chicago Board of Trade does. But the price you see on the Board of Trade is not even the price you receive. Your local grain elevator subtracts a basis, the difference between the futures price and the cash price at your delivery point. That basis can swing 20 to 40 cents per bushel depending on local supply, storage capacity, and how far you are from a river terminal. On 500 acres at 200 bushels per acre, a 30-cent basis costs you $30,000. That money does not appear on any fantasy spreadsheet. And here is a risk that has nothing to do with weather or soil. Roughly 40% of the corn grown in the United States goes to ethanol production. That demand exists because of a federal policy called the Renewable Fuel Standard. It is not driven by consumer preference. It is driven by a government mandate. If that mandate is reduced, reformed, or repealed, corn demand could drop by billions of bushels almost overnight. Your revenue is partially dependent on a law that can be changed by a vote in Congress. The price of your crop is not just set by the market. It is propped up by a regulation that may not survive the next administration. You are a price taker, squeezed between consolidated suppliers who dictate your costs and a global commodity market that dictates your revenue. Your 500 acres of dirt is a tiny, insignificant unit of production in a system designed for scale. You own the asset, but the market owns you. And you are not just exposed to domestic policy. In 2018, when the United States imposed tariffs on Chinese goods, China retaliated by placing a 25% tariff on American soybeans. Soybean prices dropped nearly $2 per bushel within weeks. Farmers who had planted soybeans expecting a normal market watched their projected revenue collapse before they could harvest. If you rotate corn and soybeans, and you should, because planting corn on the same field year after year depletes the soil and increases pest pressure, then half your acreage is exposed to trade policy decided in Washington and Beijing. A tweet, a tariff, or a diplomatic breakdown can move the price of your crop faster than any weather event. You have planted your crop. The green rows stretch to the horizon. Now you wait for the harvest check that will make this whole enterprise make sense. Let us walk through the arithmetic of a single year. Your 500 acres of corn yields 200 bushels per acre. At $4.50 per bushel, your gross revenue is $450,000. That number will appear on your loan applications and in your own hopeful projections. It looks like a business. Now subtract the variable costs. Seed, fertilizer, chemicals, and fuel run roughly $550 per acre. That is $275,000 gone before you pay a single fixed bill. Your gross margin, the money left after direct production costs, is $175,000. That margin must now cover everything else. Your hired farm manager must be paid. Their salary, plus payroll taxes and benefits, can easily reach $80,000 annually. This is not optional. You have zero experience, so someone else must make every agronomic decision. When to apply nitrogen, which hybrid to plant on which soil type, whether the field is dry enough to run the planter without compacting the soil. These are not decisions you can learn from a book in a single winter. They are decisions that come from decades of watching what this specific ground does in this specific climate. Your manager knows. You do not. That is why you are paying $80,000 for the privilege of owning a business someone else actually runs. And remember, this arithmetic assumes you are planting corn every year. You are not. You cannot. Responsible farming requires crop rotation. Most Midwest operations alternate between corn and soybeans on a yearly cycle. Corn depletes nitrogen from the soil. Soybeans fix nitrogen back into it. Skip the rotation and your yields drop, your pest pressure increases, and your fertilizer costs escalate. The soybean year changes the entire revenue picture. Soybeans yield roughly 50 bushels per acre instead of 200. At $12 per bushel, your gross revenue on 500 acres of soybeans is $300,000, not $450,000. Your variable costs are lower because soybeans require less fertilizer, but the revenue gap is significant. The soybean year is a leaner year, and it comes every other season whether you like it or not. So the $450,000 revenue number you have been using is actually the good year. The average across a 2-year rotation is closer to $375,000. That makes the operating loss even worse. Now subtract the debt service on that $1.2 million equipment loan. At 6% interest over 7 years, your annual payments approach $200,000. The combine alone loses 30% of its value in the first 3 years. If you harvest wet corn, you also need to dry it before storage or delivery. Running a propane grain dryer for a full harvest can cost $20,000 to $40,000 in fuel alone, depending on moisture levels. That cost barely registers in anyone's projection. It shows up on every farmer's bill. Insurance is another mandatory drain. A multi-peril crop insurance policy for 500 acres of corn costs roughly $10,000 per year, even with the federal government subsidizing over 60% of the premium. Add property taxes. Here is a detail most outsiders miss entirely. When a farm sells at market price, the county assessor reassesses the property at the new purchase price. The farmer who owned that land for 30 years was paying taxes on an assessed value from a different era. You just reset the assessment to current market. Your property taxes could be significantly higher than what the previous owner paid. At $30 per acre, that is $15,000 annually on your 500 acres, and that number only moves in one direction. Then there are the environmental compliance costs nobody mentions at the auction. Depending on your state and county, you may be required to maintain buffer strips along waterways, file nutrient management plans with the local conservation district, and limit the amount of nitrogen and phosphorus that runs off your fields into nearby streams. Violations can trigger fines from the state environmental agency. Repeated violations can trigger federal enforcement. These are not theoretical risks. Nutrient runoff from Midwestern farms is a primary contributor to the dead zone in the Gulf of Mexico. The regulatory pressure on agricultural runoff is increasing every year, and the cost of compliance is shifting to the individual operator. Your total fixed costs now exceed $265,000. Subtract that from your gross margin of $175,000. The result is a net operating loss of $90,000. Your 500-acre farm just generated $450,000 in revenue. The owner might not keep a dime. Revenue is not profit. Revenue is the number before the farm reveals what it actually costs to run. Now here is the question that should have occurred to you before you bought the tractor. What if you had simply bought the land and rented it out? The average cash rent for prime Iowa cropland is roughly $260 per acre. On 500 acres, that is $130,000 per year in rental income. No equipment, no operating loan, no farm manager, no chemical drift risk, no combine depreciating in the shed. You collect the rent. The tenant assumes the production risk. Your only costs are property taxes, insurance on the land itself, and a management fee if you hire someone to handle the lease. The net return on a cash rent arrangement can be 3 to 4% on the land value. Not spectacular, but positive, unlike the operating farm, which is losing $90,000 a year. The irony is brutal. The best financial move for a zero-experience landowner is to not farm at all. But you wanted to be a farmer, so you are. The operating loss on paper tells you the farm is bleeding cash, but that is not the full picture. The sign outside is not always the business inside. Your single largest hidden loss center is sitting in the machine shed. That $1.2 million equipment fleet is not an asset. It is a depreciation machine that consumes capital every single hour the engine runs. A new combine can lose 30% of its value in the first 3 years. A major engine overhaul can cost $40,000. Tires, tracks, belts, and hydraulic systems fail continuously. The repair bills arrive monthly, and they are never small. But here is the strange part. The hidden profit center is not the crop, it is the government. The federal crop insurance program subsidizes over 60% of your premium. When a drought hits or prices collapse, your multi-peril policy turns a catastrophic loss into a break-even year. Farmers have made more money from prevented planting claims than from harvesting a poor crop. Ad hoc disaster payments from Congress arrive when insurance falls short. These are not farming profits. These are taxpayer-funded risk transfers that keep the system solvent.
The second hidden profit center is the land itself. Over a 20-year horizon, prime Midwestern farmland has appreciated at rates that rival the stock market. The operating business loses $90,000 a year. The land underneath it gains hundreds of thousands in value.
You are not farming for income. You are holding a speculative real estate asset that requires you to run a manufacturing operation at a loss just to hold the asset. And you are not the only one who has figured this out. Bill Gates is now the largest private owner of farmland in the United States, with roughly 270,000 acres across multiple states. He does not farm, he leases to operators. The smart money buys the dirt and lets someone else take the production risk. You chose the other path. This is not theory. It has happened in public. The 1980s farm crisis was not a natural disaster. It was a financial one. In the 1970s, high commodity prices and easy credit convinced a generation of farmers that land values could only rise. They borrowed heavily to buy more acres at inflated prices. The arithmetic seemed foolproof. The land appreciated faster than the interest cost of the debt. Then the Federal Reserve raised interest rates to crush inflation. Commodity prices collapsed. Land values in Iowa fell more than 60% from peak to trough. The farmer who borrowed $2 million against land now worth $800,000 was not just broke, he was trapped. The asset that was supposed to secure the loan had become the anchor that sank the ship. Farm foreclosures swept the Midwest. Willie Nelson started Farm Aid in 1985, not to celebrate farming, but to stop the bleeding. The farmers who survived were not necessarily the best agronomists. They were the ones with the least debt when the cycle turned. This is the ghost that haunts every leveraged farm today. Land prices are near historic highs. Interest rates have climbed. The zero-experience owner walking into a bank in 2025 is not buying a business. They are making a leveraged bet on a commodity cycle they do not understand. The 1980s farmers were not bad at farming. They were bad at debt in a cycle that turned, and the structural forces that crushed small operators in the 80s have only accelerated. In 1970, the average American farm was around 370 acres. Today, the farms that produce the majority of the nation's crops are well over 2,000 acres. The number of farms in the country has been declining for decades, while total acreage under production has remained roughly constant. The land is not disappearing. It is consolidating into fewer, larger, more efficient operations. Your 500 acres puts you in the smallest tier of commercial grain farming. The mega operator 3 counties over is running 5,000 acres with the same combine fleet you need for 500. His cost per bushel is dramatically lower than yours. His purchasing power with input suppliers is dramatically higher. He can absorb a bad year because the good years on 5,000 acres generate enough cash reserves to weather the cycle. You cannot. You are competing against an opponent with structural advantages you can never match at your scale. And the risk does not stop at the balance sheet. You survived the first year with a small operating loss. The land appreciated. The government check arrived. You tell yourself the arithmetic works over a long enough timeline. What you do not see is the vice. The catastrophic risk is not a single bad harvest. It is a multi-year margin compression cycle. Imagine corn prices fall to $3.50 per bushel, while your input costs and interest rates remain stubbornly high. Your gross revenue drops to $350,000. Your variable costs do not move. Your fixed costs do not move. Your operating loss widens from $90,000 to $190,000. The bank reviews your loan covenants. Your equipment loan requires a debt service coverage ratio above 1.2. Your operating company cannot meet it. The lender issues a default notice. You now face a forced sale of depreciated equipment into a weak market, where every other distressed farmer is also selling. A combine worth $1.2 million new might fetch $400,000 at auction. The land is your last asset. Selling it in a downturn crystallizes every loss. But the cycle is not the only threat. The weather is. In 2012, the worst drought in 50 years hit the Corn Belt. Yields in some counties dropped to half their normal levels. Farmers who had already paid full price for seed, fertilizer, and fuel watched their revenue disappear in 90 days of relentless heat. In 2019, historic flooding across the Midwest prevented farmers from planting at all. Millions of acres sat underwater through the entire spring planting window. Fields that were supposed to produce corn produced nothing but prevented planting insurance claims. Then in 2020, a derecho, a straight-line windstorm, ripped across Iowa at speeds exceeding 140 miles per hour. The storm flattened standing corn across millions of acres in a single afternoon. Grain bins were shredded. Machine sheds collapsed. An entire year of crop production was destroyed in less than an hour. These are not once-in-a-lifetime events. They are once-in-a-decade events. And a once-in-a-decade event will happen during your ownership. You just do not know which one. Your multi-peril crop insurance will cushion the financial blow, but it will not make you whole. It covers a portion of expected revenue. It does not cover the equipment damage, the structural repairs, or the emotional cost of watching a year of work vanish in an afternoon. An experienced farmer has survived these events before. They know the playbook. They know which adjusters to call, which repairs to prioritize, and how to restructure the next season on the fly. You do not. The second catastrophic risk is invisible from the road. You misapply a herbicide. The chemical drifts onto a neighboring organic farm. That neighbor sues you for crop loss, loss of organic certification, and punitive damages. Your standard farm liability policy caps at $1 million. The settlement exceeds it. Your personal assets, held outside the limited liability company, are now exposed. Zero experience magnifies this risk exponentially. An experienced operator knows wind speed thresholds, buffer zones, and nozzle selection. You do not. You have survived the operating losses. You have survived the chemical drift lawsuit that never came. You have survived 5 years of negative cash flow while the land silently appreciated beneath your feet. Now you want out. This is where the arithmetic of the exit reveals what you actually owned. The operating company, the one you poured your capital and anxiety into, is worth almost nothing. Small farm operations typically sell for a multiple of seller discretionary earnings, often between 3 and 5 times. If your farm showed a loss or broke even, the multiple applies to 0. The business is not an asset. It is a job you paid to have. The land is the only thing with value. Prime Midwestern farmland has appreciated at rates that rival the stock market over a 20-year horizon. Your 500 acres purchased at $7,000 per acre might now be worth $9,500. The land alone could fetch $4.75 million. You are not selling a farm. You are selling a piece of real estate that happened to have a money-losing manufacturing operation on it. But even the exit has a trap. If you sell the land outright, the capital gains tax on the appreciation can consume hundreds of thousands of dollars. The only way to defer that tax bill is a 1031 exchange, where you roll the proceeds into another piece of investment real estate within a strict timeline. You escape the farm, now you are forced into another property just to avoid the tax. The generational farmer does not face this problem. When they die, their heirs receive the land at a stepped-up basis. Decades of appreciation are erased from the tax ledger in a single transfer. The outsider who bought at market price and sells at market price pays the full tax. The family that inherited and holds pays nothing. The tax code is not neutral. It is designed for generational continuity, not for outsiders entering and exiting. The most likely buyer is not another wealthy outsider with a pastoral fantasy. It is the neighboring megafarm that has been waiting a decade for your parcel to become available. They will pay for the land. They will not pay a premium for your operating company. The average farm size in the United States has been climbing steadily for decades. The small operator is being absorbed. The megafarm can spread its equipment costs across 3,000 acres instead of 500. Their cost per acre for machinery is a fraction of yours. Their volume purchasing power with seed and fertilizer companies is a fraction of yours. They can justify a full-time mechanic, a full-time agronomist, and a full-time grain marketer. You cannot. The economics of farming do not reward the small independent owner. They reward scale. And 500 acres is not scale. It is a hobby with a tax bill. Institutional investors are also circling. Pension funds and private equity firms have discovered farmland as an inflation hedge. They buy at scale, they lease to professional operators, and they do not overpay for someone else's worn-out combine. Your exit is a land sale, not a business sale. The sign at the end of the driveway will say sold. It will not say profitable. And here is the comparison that stings the most. If you had taken that same $3.5 million and invested it in a farmland real estate investment trust, a publicly traded fund that buys and leases agricultural land, you would have earned rental income, land appreciation, and dividend payments without ever stepping on a field. You would have had liquidity. You could have sold your shares any day the market was open. No equipment loans, no operating losses, no chemical drift lawsuits, no waiting a decade for the neighbor to make an offer. The REIT investor captures the same land appreciation that made your farm look successful on paper. They just skipped the manufacturing operation that lost $90,000 a year. You did not need to be a farmer to profit from farmland. You chose the hardest, most capital-intensive, most operationally risky way to own the same underlying asset. So you have walked the entire arithmetic: the land down payment, the equipment debt, the operating loss, the chemical drift lawsuit that never came, the exit that was never a business sale but a land auction. The farm you bought was never really a farm. What you purchased was a heavily regulated, capital-intensive, commodity-producing real estate asset. The operating business placed upon it lost $90,000 a year. The land underneath it appreciated by hundreds of thousands. Your primary return did not come from growing corn. It came from holding dirt in a rising market. You are not a farmer. You are a land speculator who had to run a complex manufacturing operation at a loss just to hold the asset. The fantasy was the sunrise over your own fields. The reality was a leveraged bet on the price of Iowa cropland. The serene trap closed quietly. The sign at the end of the driveway said farm. The spreadsheet said something else entirely. Owning a farm with zero experience is not buying a business. It is buying a job you are not qualified to do, on an asset you cannot afford to lose, in a system designed to squeeze the operator at both ends. The land remains. The profit does not.